Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, whether you're active, passive, you're just an industry insider, well, this is the one YouTube show and podcast that has been designed especially for you to give you all of the most up-to-date and the best information and sources, new data, research, and analysis on the multifamily industry, housing industry, and the macro economy at large. I'm joined by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Some shocking stories today. Going to be looking at the multifamily industry, reports from CBRE, Berkadia, RealPage, housing reports from Fannie Mae, National Association of Home Builders, and looking at the macro side from Slate and the Bureau of Labor Statistics. You're going to want to watch the whole episode. Make sure you like, subscribe, and follow for more. Let's get into it. All right, welcome back to the Gray Report. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital, put a great report together for us. Once again, reminder though, just before we get into it, Matt, you can catch all of these reports and a whole lot more by signing up for the Gray Capital newsletter, the Gray Report. Hop on over to graycapitalllc.com. Sign up for the weekly newsletter. Again, packed full of all the most up-to-date research reports. It is known as the best real estate and multifamily newsletter in the world, I believe. So anyway, Matt, a lot of interesting stuff. Macro economy, multifamily, and housing, which is what we're always already talking about. Let's start with macro.
Yeah.
Inflation Reduction Act. It was passed by the Senate on Sunday. Doesn't look like we're going to be reducing much inflation with it. Slate's got an interesting breakdown. I'd be curious to hear kind of your analysis and reporting as well. Seems like it is mostly a kind of quasi climate bill focusing on healthcare and the IRS. Again, I'm not really sure how that's going to tackle inflation other than they say that's going to reduce the deficit over time. Kind of sounds like a smokescreen to me, but who knows? Maybe there's a lot of good stuff in there.
Yeah, I that's what I said at first. Is like inflation reduction. It's a nice name.
Yeah.
I think all these names, when you're getting a spending bill that are this big, the name's the nicest. It's whatever the moment is.
Do you think that they just say like, what name can we put on this that may be palatable? It doesn't matter what's in the bill. Let's just pick a good name.
Yeah, I completely think that. But I have noticed more people actually talking about like the climate provisions than any kind of aggressive approach to inflation in the bill. It's interesting. They're not even giving like lip service to the inflation reduction aspect.
No.
You'll hear some critical stuff about how it doesn't necessarily reduce inflation, but like the actual meat of the bill is being talked about and praised from the left for I think a lot for climate.
It's just curious. If that's such an important thing to do, and it probably is to take some action on climate, but why not champion on that and run on that rather than the opposite and just put up some smokescreen.
Yeah.
But I guess, it's politics. So we'll have to forgive them, to a degree.
Yeah,
but,
the article itself does summarize it, and it says, to a first approximation, the bill amounts to a $370 billion climate investment paid for by prescription drug savings and tax changes. The bill's three baskets can then be analyzed separately, but the baskets are so tightly woven together that any normative assessment of the legislation must account for all three. So they're kind of getting one thing because they're giving a little bit on the other side, and they're trying to balance as much, and that at least they have an impulse. Can we give them that? An impulse to kind of balance the books. But again, this is a massive deal, and even if there is elements that aren't directly related to multifamily, there's going to be some ancillary, kind of knock-on effects. Whether it's
the spending. Spending it drives inflation.
Exactly.
Kind of at the end of the day, and then obviously the changes to kind of the tax regime, which some of them are changes to the tax code in a sense that they've got this minimum corporate tax on corporations that are making over $1 billion a year. But the big thing is they're hiring a lot more IRS agents.
Yeah.
And with the idea that they're going to be going after, the 1% or whatever. But the reality is that people who have the money that they say they want to go after also have the means to fight the IRS. And so the IRS ends up going after the individuals who don't have the means to appeal and fight the IRS. So it's middle class individuals, which again, it's like that's the biggest chunk of the population. That's where the most revenue can be generated from taxes. No one likes raising taxes on the middle class, but this is a tax on the middle class. but just in guise of eating the rich.
Well, maybe they all decide. Maybe all these new tax collectors decide they're not going to go after the middle income. They're going to go after the rich.
Yeah,
without any clarity on that issue, though, it's hard to trust that it's not going to.
I think they're going to do what they do, and they're going to run run everybody over like they typically, as they do, as federal government tends to operate. So, but it's an interesting breakdown from Slate. I recommend you checking it out again, whether that's from the newsletter or grayreport.com. Matt, any other takeaways from the Slate piece?
One thing that's not in that bill is the carried interest loophole.
Good point.
And we did call that, or you specifically called it
last week, because that was a big point for moving this forward. Was Joe Manchin basically said he was open to raising taxes by taxing carried interest or to promote related to private equity, including real estate. Basically, you're going to have to hold that asset for 3 years for it to qualify closer to capital gains rather than ordinary income. The debate around basically how do you classify carried interest? Is that really income, or is that really investment income and capital gains? It's not a guarantee that a promoter will get that, and it is like their sweat equity in a deal. I don't see how that is an investment income. Really, there should be taxed as capital gains. And again, it's easy to say, these are big fat cats on Wall Street that are making a lot of money, which people are making a lot of money. But it's also, I think, a misunderstanding of how just capitalism works in general, of how capital is allocated throughout the economy, and that these groups are capital allocators, and it's how we allocate resources as a society. You can not like that or like that, but we are punishing those capital allocators. And again, it's not going to generate much revenue. And as we discussed last week, it was essentially a call for tribute from Wall Street to the Democratic Party of saying, hey, we're going to bring up this carried interest loophole again. You don't want it to happen. All right, time to pay the toll. Pay up, pay your tribute. That happened.
A lot of lobbyists had a lot of great dinners that week. I wonder.
They had a busy week and weekend. Then Kristen Simona came in and was like, no, I don't want to do the carried interest loophole. And it got cut as we anticipated that it would last week.
Yeah. So, and only really because this discussion has happened like 2 or 3 times before.
Oh, yeah.
And anyone,
like, they're talking about carried interest again. It's like an easy thing to talk about, and that's not going to happen.
Yeah.
So I don't know. Anything can happen. But moving on, let's talk about more macro stuff. This week, we've got a new a CPI print from the Bureau of Labor and Statistics. Flat inflation growth is flattening.
Yeah.
It's still hot inflation, but it is certainly flattened compared to the last month, and we're not seeing continued growth, which you could say there's some seasonality that's associated with that, but better than having higher growth.
Yeah. No change in the CPI numbers. I wonder, there's a little bit of wishful thinking. There's a little bit of doubt, I think, that people still have, because they're still feeling inflation. The core CPI went up a little, and there's some pretty clear indications that a good part of the full CPI number, which includes food and energy prices, are falling due to gas prices. Gas prices fell precipitously last month, and that really had a big effect. Food actually still increased slightly, but gas prices really sunk down a pretty good amount since last month, especially when last month they increased by 11%. So a 7.7% reduction. That's great. Shelter is another really in that, and you can find that on the next tab. Actually, there's a detailed view which includes shelter, which is particularly relevant for multifamily housing, and as a subcategory, rental housing went up, but it went up 0.5, which is slightly less than last month's 0.6. Rental housing of a primary residence increased by 0.7%, which is slightly less than last month's 0.8%, but still within the same range as the previous few months. And like, you take 12 months of these 0.7% price increases, and you get an 8.4% increase in rent prices if these inflation numbers for rental housing stay the same throughout the year. So, kind of like, you spread that over a year, and you're almost at what inflation is right now, like year over year. And it's going to happen. The momentum of the housing supply crisis is being felt, and we're still seeing continued rent growth. And even even in my drive over when the CPI just was announced, I could hear news anchors calling out shelter inflation as something that everyone is watching. It's really starting to rise, and it will become a significant driver of inflation, more so than it already is. And it may be because all the other aspects of inflation are going to fall relatively.
It's going to keep it buoyed. Yeah.
And this is just going to keep it up.
It's sticky, and it's like long lasting, and it happens over time. And this something we've talked about constantly over the last almost 2 years now, Matt, is that there's the difference between kind of market rent growth and effective rent growth.
Yeah.
And we've seen we're still seeing strong market rent growth, which we thought we might see some, but it was more of the, market rent gets up to here, and then it takes a couple of years for all of those in place rents to finally get up to market. If people renew, 50% of people are renewing at a lower rate, so it takes a while to get all the way up to market. So it takes time to be fully absorbed. But we're seeing even more increases in the market rents, beyond that. And so it's not only are we seeing a short-term impact, but we know there's going to be a decently long tail of rent inflation over the next couple of years, which I think is part of that assumption that we're going to see elevated levels of inflation for a while. And then that goes into the wage discussion of, what drives what? Is it wages allow for further rent increases, or is it rent increases that actually lead to wage increases? Someone gets a renewal notice, your rent's going up $100 a month, $200 a month, in some cases even more than that in some markets. You're going to an employer and saying, look.
Yeah, because it's the biggest.
It's a third of your spend of an individual's budget. So you've got good evidence and good reason to saying, hey, I need a raise because my rent's gone up.
Yeah.
So, and employers want to keep and retain talent, kind of have to do it, and so it'll be interesting to see how earnings go, and if employers can keep up with their employees' demands, and what really that pricing power of employees do have. There's some debate of how strong the labor market is or is not right now. I mean, the headline unemployment number. I mean, we're at 40-year lows still, or more.
That's we'll talk about that.
We'll get into that in a second, but but then you can be, who are you counting in that number? There's some debate. The participation rate is low. We'll get into that in a second.
I just think that this interaction, what you said, is so crucial to, and it's one of the reasons why I still don't think we're necessarily out of the woods for inflation, because there's this interaction between rents and jobs, and we saw such good jobs numbers, and rent is not gonna calm down very easily. We're still not building as much as we need to, and we could just get to a point where wages are going up and rents are going up at a slower, though eventually I think they will normalize and come back down, but it's going to take them a lot longer to do so than a price of Ritz bits or whatever.
But I mean, I would also say, it's going to be interesting with wages. I mean, we are seeing in the kind of that C-class spectrum, we're having, there are delinquency issues, evictions are, going up. People are having a hard time paying, especially last month with gasoline prices so high. I think that probably has led to a lot of people trying to miss payments on rent. So we kind of need to see some of that wage growth in that bottom quartile to really kind of keep driving things, which we've seen some evidence for.
And I don't want to like splash cold water on. It is good news that all these areas of the CPI were going down, and it does decrease slightly the chances that maybe the Fed's gonna lower interest rates, but then again, there's these
exactly. And it sounds like they're pretty confident on the next one, doing probably another 75 basis points, but it's more of like after that, and how long, how many more hikes, and then does it affect their guidance, even though they say they're not going to give much guidance. But if we look at the dot plot, the bond market is predicting that there's going to be some reduction in rates kind of the latter half of 23. We'll have to see. All right. According to Bloomberg, Fed rate hike forecast raised at JP Morgan, Evercore on blowout jobs report. So speaking of jobs, Matt, we just spoke of it. Big job report. This was last week. But again, this is on the opposite side. This is, giving the Fed, again, as it says, the Fed's just going to do another 75 basis point because the labor market is so strong, apparently.
And I think this, and I may have suggested this earlier in our last, I think this is bigger news than the CPI report, arguably, at least to me, because the inflation numbers, yes, are a relative predictor, but they're from last month. And even though these jobs numbers were from last month, I think that there's a more significant story about the economy and how inflation is playing out with these job numbers in combination with inflation, rather than just thinking about, oh well, there's great jobs. That's the and that's the problem here is it's like, can we not have any good news? Is it impossible to have good news?
Yeah,
because
no, the good news isn't good news. The bad news is good news. Yeah, it's true. It's true. It's hard to make sense of it in this economy because it's a good news, seemingly good news for the consumer. Is bad news
because
based on what the Fed might do.
Yeah, because if you have, normally you'd think, oh, more jobs, that's great. But now it's like, oh no, it's either more jobs, we're going to get inflation, or now there's less jobs, we're going to get recession. So it's kind of damned if you do, damned if you don't. But in terms of the Fed land the plane metaphor, I don't know if there's anywhere to land at all. We can't even find a runway. Maybe we're looking for an empty field.
It's like a stretch of highway.
Yeah. I think that another thing that kind of contextualized where we at in terms of the jobs market is these proclamations that jobs are finally back to pre-pandemic norms. Actually, I think that you can kind of get close to an answer on the question of job growth if you look exactly at where these pre-pandemic unemployment levels were. And if you look at the Fred unemployment chart,
let's have a look.
It stretches back to 1948, and you've told me that they measured it a little bit differently in the past.
Yeah,
versus
whether
today.
if individuals are underemployed or they've dropped out of the workforce, they kind of go off the rolls. But it's for the last couple of decades we've been using the same metric, so I think that's important to use the same metric, but it is important to note that they have been counting unemployment differently over time. Yeah.
So really, the unemployment rate in January and February of 2020, this pre-pandemic low, was 3.5%, which is what it is right now. The last time, before that pre-pandemic time, the last time that the unemployment rate was that low was 1968 and 1969. Other than that, the only other time the unemployment rate was as low was in the early 50s, really from 1951 to 1953. So there's only really two moments in time where the unemployment rate has ever been as low as it is right now. So instead of saying something like unemployment's finally back to where it was before the pandemic, we should say that unemployment is down to the exceptionally low levels we were seeing in the months before the pandemic. So given this context and the fact that aside from a couple months right before the pandemic, unemployment is the lowest it's been in 50 years, there's a good case to be made that we're kind of approaching full employment. We're at that point in the Phillips curve where turning up employment really could start to disproportionately fuel inflation. And that's why I'm so interested in seeing what is happening with the jobs, because we haven't really seen as significant wage growth. And if higher employment numbers are pointing to wage growth down the line, then that's where it could really start. And I don't know if we're there yet.
I mean, and again, neither of us are economists, Matt, but from my knowledge of economics is that typically you see a lot of that wage growth kind of closer to the end of the cycle. It's not usually the first thing that happens. I mean, that certainly was the case in this last cycle, as we saw almost no wage growth, post 2008, 2009. It wasn't until, kind of pre the, 2018, 19 was when we finally saw wage growth, and then the Fed started raising interest rates again. So, but how quick that we have gone back down to this unemployment level. I mean, it's incredibly quick, and it's because I think we're in a time accelerator, the periods of time have shortened. I mean, we went through a recession incredibly quickly. We've seen almost a decade's worth of growth in about 2 years in some markets and some commodities and pricing. And there's no reason to believe that we're still not on an accelerated, or compressed time scale. And because this is funny, I was picking up some carry-out food, Chinese food last night, Matt, and at a House of Chang off of Keystone in Minneapolis. And I was sitting and waiting, and they had some economist magazines, and I was like, I'll grab one because my phone died, and it was from 2012. Yeah, and I was like, perfect. I was like a little time capsule. I was like, what was going on this episode in this edition of The Economist in 2012, and the 10-year Treasury was around where it is today. I think it was like 2.87. Yeah. But the unemployment rate was like 8.7%. And things were still not looking great then, but things were sort of better. People didn't feel that like things were better, but that was a couple years after the great financial crisis, and we still had almost 9% unemployment. And now we're less than 2 years after a recession, and we're down at 40-year low unemployment rate, where it took almost a decade on the last cycle to get down to similar low unemployment levels, and then we started seeing wage growth.
That's what I think the other kind of contextual thing that I got just from glancing at the chart is, for as sharp as things have recovered in terms of the employment rate, man, the recovery from the Great Recession was so much longer, so obviously longer compared to other to other moments in time where it's like, well, of course we did, because it took us so long last time. Maybe now we're making up for it, but there's like
it was a long cycle. It was I think it's the longest bull run in at least in recent history.
Yeah.
Between 2000 and when was the date here? July 2009 all the way to February 2020. Back here the next longest one would be March 1961 all the way to January 1970.
Just so like sandwiched between these two exceptional events, it's hard to predict.
Yeah, maybe 91 and 2001. So about 10 years or so, which is the typical cycle. But this was, similar, a little bit longer.
Yeah. So depending on what your on what your proclivities are, you can find the silver lining in a dark cloud, or you can find the dark cloud in the silver lining. It's really it is a strange moment, but I think that there are good signs. I think that job growth. I'd take job growth over a lot of other options.
Me too. Yeah, I especially in the multifamily market, because we can track inflation. Like inflation, there are downsides on the expense inflation or payroll and all of that, but it's an overall benefit to multifamily when we see inflation. We certainly have seen that over the last 2 years, to say the least. Well, let's take a turn to multifamily, Matt, and looking at this report from CBRE, the commercial mortgage markets for the second quarter of 2022. I think this report gives some pretty interesting insight to how folks are financing all kinds of different commercial mortgages, not just multifamily, but it's obviously in that basket. And it's some granular information that you don't always see. Some of it, I think, is more anecdotal and opinion. Some of it is actual data. But take us through, Matt, because you did a pretty good write-up on it. Yeah.
So this commercial mortgage market report was really interesting, and it was a rare opportunity to look at some of the trends in how these lenders are making their decisions. And one of these trends is a declining loan to value for commercial properties. Now, I think that this report actually distinguishes commercial from residential. It's not necessarily an inclusive commercial, at least as far as I understand it.
So they're talking about office.
Yeah, I think it's maybe office and retail. So commercial loan to value is 58.7%. Multifamily is at 61.7%, and the average debt yield is 5%. It looks like things are getting a little bit slower, and that multifamily gets a little bit more wiggle room compared to other property types. Yeah. I think that what's really interesting in this report is their loan underwriting measures, and they talk about how these loans, what their standards are and how they're making their decisions. And one of the, according to CBRE, the average LTV has gone down from 61.7. This is for from 61.7 in the first quarter to 60% in the second quarter. Now that's for overall all of the properties. I got confused there because it was the same number as multifamily this month, but still, the pre-pandemic average was actually 65.3. So that's a pretty big dip in how much loan you can get for a specific project. Now I'm assuming that this loan to value isn't just what the customer decides. It's based on what the bank is willing to give you.
And it's got to pass the debt service coverage ratio. You have to have enough cash in revenue coming in to not only cover your expenses, the mortgage, they want you to cover typically 20 to 30% over your mortgage amount of free cash flow. They don't want to loan you up to an amount of you're gonna not have any cash flow at the end of the day, unless it's a development loan or something.
Yeah, and it looks like things got a little bit easier and then they
they've definitely eased,
and then they
things.
got harder.
Yeah.
So in Q2 2021, you had a lot more. You had a 64.6, and then things started falling from there.
Well, but the LTVs lowered because the interest rates were higher. It's because you couldn't cross a DSCR threshold. But if you actually look, they loosened up on their DSCR. Hurdles. So it's 1.4 on average in Q2 of 22. Lenders are doing other things for like using additional amortization. So like there was an option for 35-year amortization from Fannie Mae and Freddie Mac on some loans for some qualified borrowers. People were using every trick in the book to try to maximize proceeds. There's a lot of kind of tricks to the trade to be able to do that. One of those, again, 35-year amortization certainly helps. Another thing that groups have done is subordinating some of the expenses. This is really kind of like a financial engineering trick, but the banks are totally fine with it. And one of those tricks is taking your property management fee, which is included above the line and just as a normal like operating expense.
Yeah.
But asset management fees are considered a below the line expense. And so what you can do is get creative with your property management company, or if you're the property manager, is you take a portion of your property management fee and you put it below the line. So instead of taking a 3.5% total property management fee, maybe you're going to take a 3 or a 2.75%. The remainder of that, the difference, you take as an asset management fee below the line. So it doesn't count against your net operating income.
Wow.
And so the lender doesn't look at that. And the lender's totally fine with that as long as your property management company is fine with, again, subordinating that, because it is, instead of being paid before, you pay the mortgage, which typically it's just an operating expense. You have to pay the mortgage first, then you can pay off that asset management fee. So you have to get okay with your property manager, but that's one way to boost your NOI slightly, so you can actually cross that DSCR threshold and increase your loan proceeds.
It's who you pay, the amount.
It's like it's like the order it gets paid and what it gets counted towards. And the lender's only looking at your net operating income typically.
See, this is what's interesting, and you don't normally get a look in kind of the black box of what, and I'm sure that each bank has their own kind of standards and their own things that they look at a little bit, but things like what's the priority of certain expenses as they get paid. Things like, and what they have on this chart here, they've got cap rate, amortization rate, loan to value, debt service coverage ratio. Just even having this little chart and spread out is really,
it does depend on your lender. I mean, because even like in the agencies, Fannie Mae and Freddie Mac are different. Where Freddie Mac it's like Freddie Mac's doing the underwriting. Freddie Mac is going to originate that loan, even though you may have your conduit you're going through. But on Fannie Mae, there are DUS lenders, direct underwriters and servicers that have a lot more flexibility on their underwriting, because they're the ones that are actually underwriting it. So they have a lot more flexibility on the Fannie Mae side versus Freddie Mac. Now there may be other reasons we might go with Freddie Mac, but you don't want to assume just all the agencies are the exact same, or even each lender, even every Fannie Mae DUS lender is the same. They're all a little bit different. They have different creative ideas, and it's also a relationship. But then different bridge lenders and other types of lenders also can be more or less flexible. But still, for the most part, you have to have enough income to cover your debt service. And if cap rates still are incredibly low, they haven't moved up, and if anything, they've kind of flattened and they're staying low. If interest rates are
too.
Sorry, what?
Even in their standards too, it seems like they're not giving you a break.
That much.
Yeah.
But if interest rates, if you're a floating rate, you're paying, some 2% at the beginning of this year. Now you're paying, in the 5 to 6% range. So there's a big difference. There's a lot more debt that you have to service that, cuts out of a lot of your DSCR coverage. And so you just can't take out as large of a loan. But one thing that I thought was interesting, Matt, on this report is that this decline in LTVs did not just begin with the most recent interest rate increases in March of 2022. If we actually look at it, there's been compression in LTVs, especially in multifamily, really kind of going back to 2016, 2017. And it would make sense that because in 2018, the Fed started raising interest rates, but there's really kind of been this trend line down since 2016. I mean, it really shows that the multifamily market is not over levered by any means, but there has been a big, sharp decline. There was an increase in 2021 just because interest rates were so low, you could get an incredible amount of leverage and still pass those debt service coverage ratio tests. It's amazing the difference between that a year makes. I mean, it's night and day when you're looking at a deal right now.
Yeah, it does. It is kind of interesting to see, as bumpy as it is, that things are going down, and it's still a pretty competitive market.
Very competitive.
It hasn't done.
We've been honestly a little surprised. We thought that there'd be more buyers leaving the market or a little hesitant. No, deals are still getting bid up. Cap rates are still low. People are still out there being aggressive. We thought that terms to acquire properties had kind of eased up, a little bit more of a buyer's friendly market. That lasted like a month and a half. It's
so interesting because I remember we talked about this, what was going to happen, and we interviewed Noah Stone, who formerly of Berkadia, and he really did a good job breaking down on like the volatility and was like, you know what, we don't see it's not gonna make so many waves if interest rates go up. And then interest rates went up, and I was ready to say, you know what, it is kind of making some waves, but not for very long.
Well, and because he was looking at 2013 and 2018 rate increases, and he's like, well, not much changed, and those were we saw so much more volatility in these rate increases in the speed and the just the rate of change was so much greater. It's like not the most direct comparison, but I think the analysis was correct, is that multifamily kind of acted like a Teflon investment class, whether you're talking about through the pandemic or through these rate increases. It just kind of keeps chugging along. Not that there aren't like some concerns, like compared to other assets. I mean, the fundamentals are, couldn't be more kind of straightforward.
Yeah, I agree.
So let's keep talking about multifamily. Berkadia's mid-year 2022 National Multifamily Report. A nice big American flag there on the cover. Obviously, this is a national report because it's got the American flag. So that's great. We love these Berkadia reports. Matt, what are some of the highlights?
Yeah, this was a relatively concise report for a mid-year national report, but it does begin with some contextual information about employment. Just kind of as we signaled earlier, it talks about how wages grew 5.3% annually through mid-2022, up from a 3.4% increase during the prior year. The strongest gains have been among low-skilled workers, contributing to more individuals returning to the workforce as the national unemployment rate tightened 230 basis points year over year to 3.6 by June 2022. Now it's 3.5, so it has come down even more. Class C apartments have shown slightly lower rent growth in the past compared to Class B and A properties, and an increase in wage growth, I think, for low-wage workers could strengthen the conditions for these assets. On the supply side, we're seeing, I think, a lot of deliveries. So yes, there's that employment on one hand, which is creating and supporting a strong market for multifamily properties. But these deliveries are, I don't think they're scary.
Are we going to be oversupplied, Matt? What do you think?
I think that we're going to have to build way more. Even though it is almost like a fifth of like 20% more deliveries in 2023 than any of these years previous that they're showing in this chart.
But this really emphasizes the necessity to focus on market analysis, not necessarily national analysis. Like this is good. It's like this is good to know what we're building as a nation. It doesn't mean a whole lot from a multifamily investor standpoint, but if you're not talking about market by market.
Yeah.
So I mean, look at this. I mean, there's a big chunk of this is just Dallas, Fort Worth, in South Florida, New York, Phoenix.
Yeah.
So there are in Dallas, Fort Worth, if there's one market that can absorb it, Dallas might be a market that could absorb it, and same with South Florida. And so if that's where the majority of the new supply is going on, there's other markets that are growing but they're not getting the supply. They're really kind of still in the sweet spot for fundamentals. And then you could say, I've heard people say people aren't moving to Dallas or South Florida anymore. I call malarkey on that one. Even though we're not big investors in Texas and Florida, it's just crowded. It's too efficient for us to get outsized returns. But I don't think that necessarily. I mean, there's higher risk of oversupply than other markets. I think like that would be like something to consider. It's like a worry card out here that you would want to keep on your radar. But it's not something that's like a flashing red warning signal. I would say.
Yeah, I agree, and I also think apartments, looking at national is good to give the general temperature, but when you are looking at supply, apartments aren't a fungible resource. You can't move an apartment from Toledo to Santa Fe or wherever, and people don't move as even though remote work has made a slightly more mobile population, people still aren't going to move at the drop of a hat. So when you're looking at supply, and that's going to become increasingly relevant and sensitive over the next 10 years, when you're looking at that, you look at the apartments, look at local markets and submarkets, because that's going to really determine the success of any project.
Matt, let's talk about rent and occupancy. That's kind of like the next section of this Berkadia report. It looks like effective rent is up 14.8% year over year, average of $1,736. Occupancy is also up 60 basis points for the year, averaging at 96.8% in the second quarter of 2022. Matt, that's some pretty strong fundamentals. Now, like, obviously, that's juxtaposed with the supply story we were just discussing. A couple notable markets that are doing really well. That I think in the Midwest, you might not have the top of the list. That'd be Cincinnati. It's seen some really strong top market performer, as well as Ann Arbor, West Michigan, some markets that we're in, and then some Madison, Wisconsin, Knoxville, Tennessee, San Diego, Northern New Jersey. Those are top performers by occupancy, rent growth, or it's a lot of your kind of your standard markets you might see that have just been growing like gangbusters: Orlando, Tampa, South Florida, Nashville, Raleigh, Las Vegas, Phoenix, Austin, Jacksonville, Salt Lake City. They're continuing to grow. All of those are growing north of 20%, with Salt Lake City, the lowest growth of that cohort at 20.2, and then Orlando at the top at 26.6 year over year. That's a lot of growth.
Yeah, seeing a lot of these Midwestern markets in the top of occupancy levels is really interesting.
Maybe they're not building.
I've been waiting, and I haven't seen a whole lot of the typical top performance of rent growth. I haven't seen them sinking down a little bit. Now I have heard that Phoenix may be sinking in terms of how fast the rent's growing. Maybe it's cooling off.
Oscillations up and down.
Yeah, I don't know. Is occupancy then? Is that kind of a leading indicator of rent growth? Do you watch occupancy because?
I think so. I mean, if the market's so tight, that typically indicates there's more room for growth. Yeah, absolutely.
And so I think that's particularly interesting, and maybe shows the stability and promise of the Midwest as a region. And another thing, looking at national levels, occupancy looks like it is hovering at a still elevated, around 95 and 96 as they project from 2023 to 2026. Now, this is just a projection, and a lot of times you just see like the most bland line, but their projections for rent growth are actually pretty positive. There really is not a cool down, at least in the long term. They figure seasonal dips here and there, but the growth in the next few years looks a lot stronger at a glance than the growth pre-pandemic. So with occupancy fairly elevated, and with rent growth chugging along at, I think, at an increased level through 2026, it's really interesting. It is this story of the demand eating all of these deliveries that are coming by, and there still is demand behind it.
And I think there's a renewed confidence in the market, which I think is why we're seeing cap rates staying low. But I think, comparing to earlier in the year, kind of the beginning of the year, end of 21, there was a lot of assumptions that inflation would be like over like Q1, Q2 of this year, and that there were forecasts for rent major decelerations. I think a lot of the forecasts were like, oh yeah, we're going to see like, maybe 10% rent growth, which is still crazy year, maybe 8%. We're seeing like 14%. so far. So, I mean, it's growing stronger than we thought. And then I think that's given us more confidence, because what people are concerned about is that if growth just turned off and shut off, if you had these high interest rates, you'd be in a really bad, stagflation, top heavy environment. And we're just not seeing that. We're seeing it still being supported by the fundamentals, which is keeping a lot of buyers in the market. And then even new entrants to the market who were like, where am I going to go? There's a lot of uncertainty. Multifamily seems like the most stable option, at least right now in the market.
Very good point. No cool down, no implosion, no collapse or apocalypse, just steady, strong growth. At least this week.
At least this week. We'll see if we have a new report next week of the opposite. Probably not. And then sales, just, who are the top buyers? Who's buying like the most apartments? Like who are the big extra large players in the market? No surprise here. We've got B-REIT, Blackstone, S-REIT, Cortland, and Greystar as the top buyers. In the top sellers, we've got Greystar, AIG, Brookfield Asset Management, Alliance Residential, and Crow Holdings. What's trading? Average unit is about 303 units. Average vintage in the mid 2000s.
You ever work with any of these guys?
I think we've looked at some Brookfield deals before and some Greystar deals, and Cortland, I believe, once, but not a regular basis. Average cap rate is around 4%. I think that's like a pretty good. I don't think this is like an empirical number. I think they just like wrote 4% because I think that's where they thought. And and my gut says about the same, is cap rate data is so opaque. Yeah. So I think that's a better number than like some BS number from bad data. Yeah. One thing that I think is important to mention, and this was very surprising to us, even though we've seen similar metrics, but it's still is a little shocking, is the average price per unit, average price per apartment unit. In the United States right now is $359,000. That's a lot per unit, especially here in the Midwest. But that national average makes a little bit more sense when you see what some of these large deals are actually trading for, and it begs the desire for a median unit sale number, not an average, because let's look at some of these price per units of some of these $50+ million transactions. I don't see any of our deals in here, Matt, even though we did at least one $50 million plus transaction this year. New York by jury. This is at 8 Spruce Street in New York, 903 units, built in 2010, sold for $930 million. Price per unit, $1,029,000. Wow.
That's almost $1 billion.
I remember you could buy an apartment a couple years ago for $29,000 per unit. Not the best apartment, not the best area, but American Copper. This is also New York, built in 2014. $1,099,000 per unit for a total sales price of $837 million. Wow, Matt. And there's some even crazier ones too.
This Skylark in Larkspur, California. It's on the bottom left here, and just the picture alone. So it sold
that's
for
beautiful.
$300,000 at $650 million. $300 million, and at $659,000 per unit.
But this is like a garden style 1972 vintage. This is not like a high rise. I mean, I'm sure it's been like upgraded. That's what's so interesting
to me is like all these other pictures. They look like downtown.
They've got like in the mountains. Yeah, this is like looks like a nice area, but 1972 vintage.
Yeah. Well, but here's what California. I think is interesting about it. Downtown. This could be, at least it looks like, the suburbs, and I wonder how many months where you get so many.
And the big shock for me, this is another 1970 vintage, also in California. So California is like it's an ass. Like, I don't even know why we're talking about it. It's like so different, but we have to. And if anything, to looking at that, what you don't want to hear is a broker being like, well, the average price per unit in the United States right now is $360,000.
Yeah.
So for this, 1970s vintage in the Midwest, paying $250 is just totally fine.
Yeah.
No, that's not the case, because here we see that you're using 1221 Ocean Avenue in Santa Monica, California, that was built in 1971, 120 units, traded for $330 million at $2.75 million per unit.
Yeah.
Like, come on! Like, if that's being thrown in the average, that's gonna bring the average up a little bit.
Yeah.
So again, that's why you have to be careful looking at national numbers. It's good information, but just make sure the conclusions that you're drawing from it are appropriate and you're using it the right way. And again, it's why it's important to look at more granular local data when you're really actually looking to make an investment decision.
Yeah.
So great report from Berkadia. Now let's jump into another report from RealPage, from the RealPage Analytics blog. As expected, apartment rent growth moderates slightly in July. This is a report by Jay Parsons. He's been putting out some really, really great, insightful stuff. Matt, break it down for us.
Yeah, another great report from Jay Parsons. I've been reading a lot. Every week it seems like we come across one, and whether it's this or some of his comments,
make some good
elsewhere.
LinkedIn posts.
Yeah, I was going to say I read a few good LinkedIn posts, and I feel like I'm on the same wavelength. I'd love Jay Parsons, if you want to come on the Great Report.
And sometimes,
I'd love to have you.
Jay, open invite. And what I like it is that he sometimes, like, the data that he points to kind of goes against like the general narrative of like,
yes, for sure.
Like, hey, I know this is what everyone thinks, but like here's the data, and it's not necessarily jiving to what everyone is assuming.
And that's what I was saying last year is like, don't call it a cool down. You can call it Let's call it a moderating. Let's call it a lot, but rent growth is
or normalization.
But it's hard to call it a cool down when it's already so elevated. If you take out last year's incredible rent growth, and we kind of saw that chart just now, the rent growth of 2022 is stronger than any other year in the past decade. So there's a lot of reasons why this is a strong year, and why you really shouldn't call it a cool down. Rent to income rates are really another interesting thing. They support further rent growth, and the numbers for rent growth would be incredible again if it wasn't for the easy comparison of 2021. Year over year, asking rent was up 12.2% in July, and for new leases, the rent growth number was 17.2%. For renewals, and this is just for renewals, rent growth was at 11%. Huge, high numbers.
Yeah.
I'm particularly surprised at the 11% numbers, but wow. And then another thing that there's kind of a twist at the end of the article. I don't know if it's much
I
of a
love an
twist.
article with a twist.
That's right. He leaves us at like the very last line. He says, reduced apartment demand is not especially concerning for now, given ultra low vacancy. But it could become concerning if sustained through 2023, when apartment supply levels will soar to 40-year highs. I think that this increased supply, as we've mentioned before, I think it's going to be absorbed by renters. And my expectation is that we are going to see more supply in the hot in-demand markets, not necessarily in the ones that are outside the scope of these popular markets. But again, and you said it right, is the supply problems it's a local issue. You got to check your own backyard, because it's not happening uniformly across the entire nation.
Yeah, if I was in Huntsville or Houston, I'd want to, Austin, I'd want to be checking on it. And I think that it's something. It's a concern that's like should be noted. I think in some cases it is being discounted, probably appropriately, but it's definitely something, especially in certain markets, that is a major concern. It's in Indianapolis, like that's not a major concern right now. Like we had a bunch of supply come online downtown a couple of years ago. It was like multiples of units that have ever been developed downtown. Downtown softened for a couple of years. Construction pipeline slowed down, but there's no other construction. The rest of Indianapolis, and people want to live other parts of the city, and we're so undersupplied, and we're just still not seeing. We're building less than we've built over the last decade.
It is, and that is what I said. It's not a fungible good, and it's also it's not like they're building these apartments at such a great rate where this is a situation where one apartment building could change at least like that submarket. So it is very interesting.
Absolutely, in some submarkets it can. Absolutely. Well, let's make a little bit of a downshift and talk about just more kind of like the housing market. National Housing Survey. This is coming out from Fannie Mae. It's one conclusion, just to fast forward, Matt, is that when everyone is down on housing is typically a great time to buy housing.
Yeah. That is a very good point. We covered this last month. Still worth covering this month, I think, even though the trend's the same. The news, I think, is that the trend is the same. A lot of stuff has happened in the housing market to make me think, well, I don't know if there are more listings out there, if prices, if home values are going down a little bit. I thought that it might be easier for buyers, but they're still not agreeing.
No.
They're not agreeing with me.
No.
I wish I had the master key to the sentiments of humanity, but I don't. Can't even jimmy the door. But that's not to say that these sentiments are invalid. I think they're just illogical. Inflation, higher interest rates, and still high home prices are hitting home buyers really hard. And I just think it's interesting that we are approaching the same level of low sentiment that we saw in the wake of the Great Housing Crisis. And I don't think that it doesn't feel like we are.
Is that appropriate?
Yeah, I don't think it's appropriate.
No.
But again, I
This is people that are just like burned. I think is part of it is because it's like there's a lot of FOMO.
Mm-hmm.
They're like, screw it.
Compared to they're looking at, oh man, if I just bought last year when I already thought the housing market was too expensive.
And now it's like, I know it's a bad time to buy because I can't qualify. So of course it's a bad time because I can't even buy it if I wanted to.
Yeah. So and it will be interesting to see, whether it's the sales volumes of single family homes or whether it is home prices or home values, but how these sentiments actually result in actions that we can really record in the home buying market.
Yeah. But let's just then shift over on a similar parallel track to Ion Housing, National Association of Home Builders. Single family homes started in 2021. Looks like we're still building, maybe at a little bit lower, a little bit less.
So it does feel like that. It may feel like that, but we've built a heck of a lot of homes this past year.
Yeah, we have. I know I think permits have fallen. That's outside this report, Matt. Break it down.
So basically, nationally, 1,133,145 new single-family units were started in 2021. That's 14% higher than the units started in 2020, which was the fastest growth rate since 2023 and the highest count of starts since the Great Recession.
The highest growth rate since 2023?
I'm sorry,
2013?
2013.
Yeah, that makes sense. From the future.
Yeah, it's higher than the future. Well, the point is there was a lot of growth, and this sentiment is still very low. So the only thing that I can think of here is that we've got so much high demand. It's eating all this supply up. It's not really moving it's not really making a material impact in prices or the overall environment.
It has hit the home builders have definitely started softening. They're pretty sensitive to all of this, and I know that they've slowed down their permits. I mean, 2021 was gangbusters, and 2022 the first half I know was, but I think they have slowed down.
Okay.
Kind of rolling out building new homes,
and
which
that
could lead to
sense,
further supply shocks. As we still have demand, but we ended up never buying the houses that we needed.
That makes sense. And I wonder if they're talking about, these projects that were started maybe in 2021 and then they're finishing now. But if a similar project came up now, they probably wouldn't pursue it.
Yeah, I think so. Well, certainly not speculative developments where they're like, hey, rate anyone can borrow, free money is being, sloshed around. I'm gonna build because I can't build fast enough now. It's like, well, a big chunk of anyone who's thinking about buying a home for the first time, they've just been taken out of the market.
Yeah.
So definitely slowed down. That largest demographic, millennials, have certainly been hampered by that. Those who missed out very much on, unfortunately. Yeah. Well, Matt, this is a jam-packed full report. Some shocking developments and some interesting conclusions. Fortunately, you can find these reports every single week on the Gray Report. Whether you're watching on YouTube, you're listening on the podcast, you are catching us on the newsletter that's delivered to your inbox every Thursday morning at 8:30 Eastern. We also have grayreport.com. It is the leading multifamily intelligence aggregator. You're not going to find anything else like it anywhere on the internet or your cell phone or the Wire, Telegram. There's nothing even close to it. So check it out, grayreport.com. Make sure you've subscribed to the YouTube channel. That way you're going to get a little alert. It's like, hey, there's a new episode of the Gray Report. Get your download of all of your multifamily intel. We'll bring it straight to your ears every single week. Give us a comment. Think if we're right, smart, dumb, wrong, most likely wrong, not right. Maybe we've got a couple things going in the right direction. Let us know. We love your support. And then share this because, one, that helps the algorithm. More people can get this content. we're trying to bring this information, free to you because we think it's going to make a more efficient market. And the more educated people are, the better decisions we can all make. We hope this is of value to you, and you can show your appreciation for listening by giving it a share after you've liked. And of course, you've subscribed. And lastly, if you're an accredited investor, hop on over to gray.fund. It is the landing page for Gray Capital's multifamily investment fund. Again, only open to accredited investors, but we're targeting some really exciting opportunities in Midwestern United States, all existing cash flowing assets, credible properties where we got 2 assets in the fund. We got a bunch of deals in the pipeline. We'd love to have a conversation with you. Again, you have to be accredited. Hop on over to gray.fund, download the deck, schedule an appointment, and learn more. Any weekend plans, Matt?
A lot of relaxation.
Excellent. All right. Have a great rest of your week, a great weekend. Catch you on next episode of The Gray Report.